Welcome to the deep dive. Today, we're zeroing in on a really key idea in finance and auditing, going concern.
Yeah, it sounds a bit technical, but it's basically the assumption that a company is going to stick around.
Exactly. Think of it as the foundation for how we even read financial statements. And we're digging into the official standard today, right?
That's right. The International Standard on Auditing 570, revised, ISA 570. It's kind of the rule book for auditors on this specific issue.
So, for everyone listening, this deep dive is all about making sense of going concern, what it means for a company, and importantly, what auditors have to do about it.
Mm. And we're using excerpts directly from ISA 570, so straight from the source.
Our mission then is pretty simple. Cut through the jargon, explain these core auditing ideas, and show why they actually matter. Okay, let's dive in. What's the absolute core of this going concern idea?
Well, at its heart, it's this fundamental assumption. When you prepare financial statements, you assume the company isn't going bust tomorrow. It's expected to keep operating for the foreseeable future. That's the default, unless management actually plans to liquidate or shut things down or really has no other choice.
So it's like the background setting is business as usual, unless there's a big sign saying otherwise. How does that assumption actually change how numbers get recorded?
It changes everything, really, because
Mm.
you assume continuity, assets, and liabilities are recorded on the basis that the company will, realize its assets, sell its stuff, get paid by customers, and pay off its debts in the normal way.
Okay.
If the company was about to close, you'd look at assets very differently, like what's the fire sale price, not what's its value in an ongoing business. It's a huge difference.
That makes a lot of sense. So who's actually responsible for figuring out if the company can keep going? Is it the auditors?
No, not initially.
Hmm.
That's squarely on management's shoulders. Management has to make a specific assessment. They have to look at the situation and judge the company's ability to continue.
Okay, management makes the call.
Yeah, and some rule sets, some
Yeah.
financial reporting frameworks actually require them to formally make and document this assessment. But even if it's not explicitly written down as a rule everywhere.
It's still fundamental.
Exactly. It's so basic to preparing financials that management is kind of implicitly doing it anyway.
And is there a set period they need to look at, like how far into the future?
Generally, yes. The standard says they need to look out at least 12 months from the end of the reporting period.
At least 12 months.
Right. So financials ending December 31st, 2024. Management needs to assess if the company is viable through at least December 31st, 2025.
Okay, so management assesses for the next year plus, but then the auditors step in. What's their angle here?
Absolutely. The auditors come in, and their job is twofold, really. First, get enough good evidence about whether management's use of that going concern basis is actually appropriate.
Okay, check management's homework, basically.
You could say that. And second, based on that evidence, conclude if there's what's called a material uncertainty about the company's ability to continue as a going concern.
Material uncertainty. That sounds like the key phrase. How do auditors even start sniffing that out?
Well, it starts with risk assessment. Early on, they're looking for any events or conditions, any red flags that might cast significant doubt.
Like what sort of things?
Oh, it could be financial stuff, like are they drowning in debt? Are they making huge losses? Or operational things, did they lose their biggest customer? Can they even get the supplies they need? Or other factors too.
So if they spot one of these potential red flags,
Yeah.
then what?
Then they have to dig deeper. They can't just ignore it. They need to talk to management, understand the issue, and crucially find out what management plans to do about it.
The recovery plan.
Exactly. And the auditor doesn't just take management's word for it. They have to evaluate that plan. Is it realistic? Is it likely to work? They need to challenge the assumptions.
And this isn't just a checkbox exercise at the start, I guess. They keep an eye on this throughout.
Oh, absolutely. You have to stay alert the whole time.
Yeah.
Through the entire audit. Because things can change, right?
Yeah.
New information might pop up that raises doubts, maybe something that wasn't obvious initially.
Okay. So when the auditor is evaluating management's assessment, what are they really trying to confirm?
They're looking at the reasonableness of it all.
Hmm.
Did management consider all the relevant information that they should have known about at the time?
Right.
Is the period they looked at, that minimum 12 months, actually long enough given the specific situation? Sometimes looking just 12 months ahead might not be sufficient if there are big known problems looming just after that.
So if management looked further than 12 months, the auditor considers that too.
Yeah, they should ask about it. If management did, say, an 18-month forecast, The auditor needs to understand if any big risks pop up in months 13 to 18. They need to look at the whole picture management considered.
Okay, let's say the auditor does find stuff. Real events, real conditions, creating significant doubt. What extra steps might they take then? What specific procedures?
Well, that triggers more detailed work. They might really scrutinize management's plans, maybe test the assumptions in their cash flow forecasts. Like, are these sales projections believable?
Okay.
They might read the fine print in loan agreements. Are they about to breach a covenant? They'll likely read board minutes to see what the directors were discussing.
Get the inside scoop?
Sort of. And maybe even confirm things directly with, say, related parties or lenders about potential financial support. It's about getting solid evidence.
Sounds pretty thorough. So after all this digging, the auditor has to land somewhere. What are the possible outcomes, the conclusions they reach?
Ultimately, they have to conclude, is there or is there not a material uncertainty related to going concern? And just to be clear, a material uncertainty is when something is potentially so significant,
Too big.
so big that it really makes you question if the company can make it. If using that going concern basis is still okay.
And that conclusion directly impacts the auditor's report, the thing investors and lenders read.
Hugely. It really comes down to two things. One, was management right to use the going concern basis in the first place? And two, if there's a material uncertainty, did they disclose it properly in the financial statements?
Okay, walk us through the scenarios. What if everything looks fine? Going concern basis, okay, no material uncertainty found.
That's the best case scenario. The auditor issues an unmodified opinion, a clean report.
Simple enough, but what if there is a material uncertainty?
Okay, now it depends. If the material uncertainty exists, BUT management has adequately disclosed it.
Meaning they explained it clearly in the notes to the financials.
Exactly. They laid out the situation, the risks, their plans. If that disclosure is good, the auditor still issues an unmodified opinion on the financials themselves. However,
There's a catch.
there's a big catch. They have to add a separate section to the report with a specific heading. Material uncertainty related to going concern.
Ah, so it's flagged prominently.
Very prominently. It basically shouts, hey reader, the numbers are presented okay based on the situation, but be aware there's this big uncertainty about the future. It's a massive red flag for anyone reading the report.
So, unmodified opinion, but with a huge asterisk pointing to that section. What if the auditor thinks using the going concern basis was just plain wrong from the start?
Well, if the auditor concludes the whole going concern assumption is inappropriate, maybe the evidence just overwhelmingly points to the company not surviving,
Then,
then they issue an adverse opinion. That's really serious. It means the financial statements as a whole are misleading. Don't rely on them.
wow, okay. And the last scenario. A material uncertainty exists, but management didn't disclose it properly. They tried to hide it or downplay it.
If it exists and isn't adequately disclosed, the auditor can't give a clean opinion. They'll issue either a qualified opinion or an adverse opinion.
Qualified or adverse, what's the difference there?
A qualified opinion is like saying, everything looks okay except for this one specific major issue, the lack of disclosure about the going concern uncertainty. An adverse opinion is stronger, saying the lack of disclosure is so pervasive, so critical, that the entire financial statements are misleading.
Got it. So either way, the auditor is signaling a big problem with the financials because this key information is missing or obscured.
Precisely. The auditor's report really acts as a vital signal to the market about the company's potential future viability.
And is the report the only place this gets communicated, or do auditors talk to anyone else?
Oh, definitely. They're required to communicate these findings, especially any significant doubts or material uncertainties, directly with those charged with governance.
So the board of directors, the audit committee.
Usually, yes.
Yeah.
The top level needs to be fully aware of the auditor's concerns about going concern. It's a critical part of governance.
This really paints a clear picture. And the standard itself, ISA 570, it gives examples of these events or conditions that might trigger doubts, doesn't it?
It does, yes. In the application material, they're really helpful illustrations. On the financial side, things like having more liabilities than assets, a net liability position,
That sounds bad.
usually is, or having more short-term debts than short-term assets and net current liability position. Also, big loans coming due soon with no clear way to repay or refinance them.
What other financial signs?
Signs that banks or lenders might be pulling back support, consistently burning through cash and operations, negative operating cash flows, big ongoing losses, not being able to pay your bills or suppliers on time. Basically, signs the financial engine is sputtering.
Okay, makes sense. And it's not just pure finance, right? Operational issues count too.
Absolutely. Losing key managers, the people who really run the show.
Yeah.
Losing a major market, or your biggest customer.
Ouch.
Or losing a critical license or franchise, or even a key supplier you depend on. Big labor problems like strikes, or just not being able to get the essential materials you need to make your product. These can all threaten the company's ability to actually operate.
Yeah, you can see how those could cripple a business. Any other categories?
There's a sort of other bucket, too. Things like breaking rules, capital requirements, legal regulations that could lead to fines or being shut down,
Right.
major lawsuits hanging over the company's head, big changes in laws that hurt the business model, or even, catastrophes, fires, floods, especially if the company isn't properly insured.
Wow, okay. So it's a wide range of potential threats. But seeing one of these doesn't automatically mean the company is doomed, does it? Can things mitigate these problems?
That's a really crucial point. Yes, the presence of these factors raises doubt, but their significance can often be lessened or mitigated by management's plans.
Back to the plans.
Right. If management has solid, believable plans to deal with the issues, maybe they're selling off non-core assets to raise cash, or they've successfully negotiated new loan terms, or they have firm commitments for new investment.
Then that changes the picture.
It can, yes. The auditor then has to evaluate how feasible and effective those mitigating plans are likely to be. It's not just the problem, it's the response, too.
This has been, well, really illuminating. A proper deep dive into going concern. So just to kind of wrap it up for everyone listening.
Sure. I think the key takeaways are going concern is that bedrock assumption the company keeps running. Management has to assess this looking out at least a year.
And auditors have a vital job checking that assessment.
Right. They gather evidence, look for material uncertainties, and their final report flags any major concerns about the company's future viability. It's a critical piece of financial reporting.
Yeah, understanding this gives you a much sharper lens for looking at any company's financial health. It's not just about past performance, but about future prospects, future sustainability.
Exactly right. Which leads to maybe a final thought for our listeners to ponder. How often do we just assume businesses will keep going? In our daily lives, the stores we use, the places we work, the stocks we might own?
Yeah, we take it for granted.
We really do. So what could the knock-on effects be if that assumption suddenly proved wrong for a major company? And thinking beyond the formal audit reports, what other clues, maybe less obvious signs, might hint that a company's long-term future isn't quite as secure as it seems? Something to think about.